Netflix just reported its earnings, and oh my fucking god, they really learned a lot from Love is Blind. They took that show, Love is Blind, which is actually probably the best reality dating show that my girlfriend has ever tortured me into watching. Now I'm a huge fan of it, I have to say. But Netflix went ahead and turned Love is Blind into Investors Are Blind for the latest quarter because they just reported a huge surge in ad tier subscribers, up 35% compared to last year, and the stock was off to the races after hours. What's up, apes? Welcome back to another edition of the 𝗪𝗚𝗪𝗀 daily podcast of the day. Thank you all for joining us here once again at the world's most powerful and most influential podcast. Also the wealthiest with the handsomest host, if I don't mind saying so myself. It is currently 5:46 p.m. on this beautiful Thursday, October 17th, 2024. Hope everybody's fired up to have one hell of a Halloween about, is it exactly 2 weeks from today? I think it is 2 weeks from today, so that's going to be pretty sweet. Second best holiday of the year, besides the 4th of July is the only one that could outdo Halloween, in my personal opinion. We got a lot to talk about here today. We're kind of hitting the sweet spot with earnings season coming into next week, so we want to get everybody prepared for that. We want to talk about some of the economic nonsense that was going on here today, and of course we'll be breaking down a lot of the big stock movers. We had some big there's actually a new couple on Wall Street, or a rumored new couple on Wall Street, as Uber has developed a crush on one of its peers, so we'll talk about exactly what's going on there. Before we get into all that, let's go ahead and take a look at the WSO Alpha portfolio. The Alpha portfolio, rough day for the fellas, and we were down about 33 basis points for the session here today, while the S&P 500 was down just a measly little 2 basis points. The NASDAQ had a pretty flat session as well, up 4 basis points. Russell 2000 more in our territory at a 27 basis point loss. Then not that anybody cares, but the Dow was up 37 basis points. Big reason for underperformance today was one holding in particular, 𝗪𝗲𝗪𝗀. We'll talk about exactly why in a second, but they had a really shitty earnings report, and the stock finished down, I think, close to 11%, if I remember correctly. Yeah, 10.6% or so. But we'll break that down in a quick minute, so make sure to stick around. Before we do that, let's go ahead and hop into some of these banana bits. First and foremost, we've talked a lot about earnings estimates yesterday. Now, yesterday was a particularly long edition of the 𝗪𝗚𝗪𝗀 daily podcast of the day, so I don't blame you if you missed it. Skip by that portion of the video or whatever else it might be. But earnings estimates in Europe are even worse, arguably falling faster than Poland did back in 1939. So it's not looking too good for earnings season over on the continent. But still, you never know. I mean, really, what is there? 6 companies in Europe. There's Novo Nordisk. There's, I literally can't even think of another one. There's SAP, I know is a big one. ASML, obviously, we talked a lot about yesterday. LVMH is another big company. And then, I don't know, I assume there are more. But you can't just have fucking chocolate and Ozempic. Well, I guess you can. That's actually kind of a dream. By the way, chocolate, where did that come from? I think LVMH sells chocolate, but I could be very wrong on that. Anyway, let's go ahead and just move into the next banana bit here. So, Netflix just reported its earnings, and oh my fucking god, they really learned a lot from Love is Blind. They took that show, Love is Blind, which is actually probably the best reality dating show that my girlfriend has ever tortured me into watching. Now I'm a huge fan of it, I have to say. But Netflix went ahead and turned Love is Blind into Investors Are Blind for the latest quarter because they just reported a huge surge in ad tier subscribers, up 35% compared to last year, and the stock was off to the races after hours. Let's see how high up it is after hours as of right now. Keep in mind, it is just 5:49 p.m. at this point, so we still got plenty of room to run before the 8 o'clock closure of the after-hours sessions. Yep, up just over 5%, so we'll be writing about that on Monday. Meanwhile, you heard me say it earlier, Uber has a pretty big crush on another company as they are considering a $20 billion acquisition of, drumroll please, Expedia. I don't really know if this is a match made in heaven or a match made on fucking the island of misfit toys, but still, it sounds pretty cool. Maybe some travel benefits would actually make Uber one worth subscribing to, but I know what certainly is worth subscribing to is shares of Blackstone, especially after this latest quarter. The stock absolutely rocketed for the session here today. We didn't have space to talk about it, but it was up 6.3% on the session because Blackstone reported stellar earnings. In particular, the net asset value of its infrastructure and private equity interval funds absolutely took off. That really carried the entire team for the quarter. They got a 10% rise in assets under management as well as assets under custody as well. Higher fees, higher AUMs. That's the story of financial services for the quarter. Meanwhile, the Wall Street Journal just wrote a fucking book about what round 2 of a potential President Trump presidency would look like for global trade. So definitely check that stuff out. And then guys, everybody, please just take a second and thank whatever God you believe or don't believe in that Google just announced that election advertisements, election ads, aka the scourge of every single American's existence right now, are going to be blocked on the platform, which sounds great, but then you read the next sentence and realize that they're not going to be blocked until after November 5th. They're going to be blocked after polls close, but still, there's, with the amount that they're spending, there's probably going to be run over ads going into fucking March of next year, or maybe next election cycle when we have, who's it going to be, fucking RFK versus Elizabeth Warren or something like that. Jesus Christ, we're going to be in a lot of trouble at that point. But either way, there's been a lot spent on this stuff, so there's probably going to be some leftover afterwards. Great to hear that Google is going to be blocking that degeneracy. Anyway, moving on down into our big story of the day, Macro Monkey. We are, of course, talking about retail sales. One of our favorite things to discuss here, getting into consumer spending, because that is the economic driver of the United States economy. Given that the United States economy is the driver of global GDP, the U.S. consumer really does kind of run the show when it comes to global economic growth. Now, the U.S. consumer is a group of people who love to whine about high prices, but they seem to have no problem paying for those high prices, at least on a monthly basis, as we'll see. But, whining about high prices is probably, and still buying them, that's probably the most American thing that you can do. It's two of our favorite hobbies, complaining and wasting money. Hits the nail on the head right there. So it's a wonderful activity for us. Personally, I don't think anybody does either one of those two things better than I did, but you guys certainly gave me a run for my money, no pun intended, last month in September, especially when it came to total consumer spending. So yesterday, the Census Bureau, I don't know why the Census Bureau counts this data, but they do. They released their latest report. Technically, it's called the Advanced Monthly Sales for Retail and Food Services Report, aka the Retail Sales Report. So according to the Census Bureau, in September, total retail sales grew 0.4% from August. That was above the 0.3% increase that economists had been guesstimating, and it was an improvement from the 0.1% increase that we saw in August. Now, if we exclude auto sales, which actually declined for the month, but play a huge role in total retail sales because, I don't know if you guys know this, but buying a car, pretty high ticket purchase. So even if auto sales have if they have a relatively a small percentage change on a monthly basis, it's still going to have a pretty big impact just because it's such a high dollar amount for each one of those purchases. So if we exclude auto sales, we go from a 0.4% increase to a 0.5% increase, also above guesstimates that had been pegging this at 0.1%. But if we exclude what the Census Bureau calls food service and drinking places, because apparently nobody's ever invited them to a bar or restaurant before, we can go ahead and see that retail sales increased 0.3% in September, meaning that food services and drinking places increased by 0.1%. So, also, if we exclude food services, pure retail trade increased 1.4% from September of 2023. This is all going to be important in a second. Meanwhile, on an annual basis, we saw a 7.1% increase in non-store retailers, which, holy fuck, I don't know why the Census Bureau has to use the nerdiest names possible. Non-store retailers, just call it e-commerce or literally just Amazon and we'll all understand what you're meaning. Increased 7.1% for the year, very high growth rate. And then restaurants posted an annual increase of 3.7% compared to September of 2023. So in total, all in all, on an annual basis, which is really the figure that we care about here today, total retail sales increased 1.7%. Now, that was above economists' guesstimate. So that might seem good on its face, but let's go ahead, rewind the clock a little bit to this time last week, Thursday of last week, when the latest CPI report for the month of September came out. They told us that inflation was at approximately 2.4% for the month. Well, that means that we are not seeing retail sales growth, at least on an inflation-adjusted basis right now. So if we go ahead and do the complex math of subtracting 2.4 from 1.7, I know it seems crazy to subtract a bigger number from a smaller number. It took me a while to figure that out. We can see that retail sales on a real inflation-adjusted basis decreased 67 basis points, or 0.67%, from September 2023 to September of 2024. That is horrific. That's like if you had a patient in a hospital bed and their fucking heartbeat stopped. That's exactly what's happening to the U.S. economy. But the question is, at this point, it's like it's only stopped for like when we would have expected like one beat. So did their heart skip a beat? Am I that charming, I guess? Like, did their heart just skip a beat, or is this a problem and the patient's about to die on us? So that's kind of the economic scenario that we're in right now. Now, if we go ahead and extrapolate to some of the other data that was released on Thursday, specifically the initial jobless claims report for the latest week, we can see that, conditions overall aren't too terrible. So the Labor Department released its initial jobless claims report, which showed initial jobless claims coming in at 241,000. That's a 19,000 decline, and it's also 19,000 jobs lower than what economists had been expecting for initial jobless claims. So overall, was looking pretty good, even despite the fact with Hurricane Helene and Hurricane Milton, the labor market was able to hold up relatively well. Wage gains have still been holding up pretty solidly, at least according to the latest PCE report. So we're seeing a strong underpinning in the labor market. We're seeing continued wage growth, but consumers are very hesitant to spend. If we look at some of the other consumer spending data that we've gotten in recent weeks, Bank of America's internal data suggested a 0.9% decline in annual consumer spending. I assume that's inflation adjusted. They didn't actually say it in the consumer checkpoint, and I read every single one of those footnotes. Go ahead and look at that fucking piece. Look at those footnotes and tell me you don't want to, Jesus Christ, go ahead and meet fucking Harambe or something, whatever you guys want to reference. But so Bank of America said that spending declined 0.9%. On an inflation-adjusted basis, that means that spending actually declined 3.3% for the period per Bank of America's data. But then if we go ahead and take a look at August's PCE report, because we don't have the September PCE report until Halloween, certainly hope it's not that spooky, but the August PCE report suggested that personal consumption expenditures, aka their version of consumer spending, was up 2.9% on a real basis. So before adjusting for inflation, we're closer to about 5.2, 5.3%. After inflation, 2.9. So very strange, because on the retail sales side, we're seeing a nominal increase of 1.7% and a real decline of about 0.7%. On the Bank of America side, we're seeing a 0.9% nominal decline and a 3.3% real decline in consumer spending. And then via the PCE report, we're seeing a 5.2% increase in consumer spending and a 2.9% increase on the real side of consumer spending. So basically, nobody has any idea what's going on. I mean, it's what we've been saying for the past couple of weeks at this point. It's really just overall economic opacity is causing confusion for everybody. We don't know when to spend money. We don't know if we have money to spend. And I think that this is causing a lot of the confusion, variance, divergence that we're also seeing in the consumer sentiment data that we'll be talking about after we get through these stock movers. That was probably the best segue I have ever done. So I'm pretty proud of myself. You guys can send tips to my Venmo. Taiwan Semiconductor Manufacturing Co. is going to be leading us off for the What's Ripe stock movers of the day. They could, much like the U.S. government, they got to work on getting a catchier name over here. Like, goddamn, it's actually called Taiwan Semiconductor Manufacturing Company Limited. It's technically its legal name, or TSM, as we prefer to call it here in the equities market in the United States. Really, it should be TSMC, because that's what everybody refers to it as, but the stock ticker is TSM. Did we look at this the last time I talked about TSMC? Is there a ticker that's TSMC? Let me see. Well, Taiwan Semiconductor Manufacturing Co. comes up. They should fucking change that. I'm going to call somebody. I'm sure, after all, we do run the most popular and influential podcast in the world. I'm sure we can go ahead and change some minds. Anyway, Taiwan Semi was up 9.79% on Thursday because the company managed to survive yet another quarter without World War III breaking out on its island. So the company was looking pretty good. It turns out that selling literally the highest demand product in the entire world is a pretty good business model to be in. The world's largest chip foundry really capitalized on that demand for artificial intelligence chips. They posted a 36% increase to revenue and a 56% rise in profits compared to last year. Both completely dominated the street estimates, but easily the best part was the increase to guidance for the full fiscal year of 2024. Originally, TSMC had been projecting for about 20 to 25% revenue growth. Now we're looking closer to about 30%. So that's wonderful. But the biggest piece to hitting that 30% is going to be the ramp up in production of NVIDIA's Blackwell chips. In case anybody didn't know that, NVIDIA doesn't actually make these things. They design them. TSMC makes them and at least makes the processors for just about all of their chips. Sends them back to NVIDIA, and then NVIDIA can go ahead and sell them, and TSMC makes, whatever amount they're going to make. But if you're wondering if you want to get a good proxy for TSMC's revenue, just look at NVIDIA's COGS. That's really going to be a good kind of telling point for you right there. But that's about it for TSMC. They sell semiconductors. Do we really have to explain how they beat earnings from there? It's 2024. Get with the program. Expedia, up 4.75% on the day because, man, they have a new secret admirer. Really not so secret admirer after yesterday. Somebody must have spilled the beans at lunch on Wednesday, because by Wednesday evening, rumors were swirling all around school that Uber has a crush on Expedia. Pretty embarrassing if you ask me. But the ride-sharing firm is reportedly considering exploring a $20 billion takeover bid of Expedia. Obviously, goes without saying, this would be Uber's largest ever acquisition. I think Uber's at, what, like $100 billion valuation? Is that fucking stupid to say? $167 billion. Okay, I don't feel like too much of an idiot because of that. 85 PE ratio. Holy shit. I would have thought it would be higher, if anything, to be honest with you. Anyway, so Uber is going to use $20 billion or so to purchase Expedia. I'm sure it's going to be in a share-based acquisition because it's so much easier for these kinds of companies. Obviously, like I said, this is Uber's largest ever acquisition. Now, the FT did try to kind of chill things out a little bit. They basically said that Uber is still very much in the early stages. They're just in the talking stages right now. They're not dating or anything at this point. They're certainly not in a relationship, to use the modern lingo, I guess. I don't really know personally, but the real benefit that I could see out of this, at least for consumers, is if there's some kind of travel benefit from Expedia for using Uber One, and that might actually make me sign up for that bullshit so I can stop getting 5 emails a day telling me how fucking great Uber One is. Oh my god, 5% off at fucking Domino's. Like, holy shit, as if Domino's isn't going to give me 40% off just for going onto their website. Give me a break here. Who do you think you're messing with? Anyway, moving on into our stinky rotten moves of the day, we have Lucid down 17.99% for the session. Horrific, embarrassing. How can you look your mom in the eyes after your stock is down 17.99%? Lucid learned a very hard lesson here today. So this will be some great knowledge for all of you, wannabe masters of the universe, everybody who wants to work on Wall Street. There are 3 things that you're allowed to raise on Wall Street: bonuses, EPS targets, and the roof. One thing you absolutely are not allowed to raise is capital through equity offerings. And that's exactly what Lucid went ahead and did yesterday. They're fucking around, and boy, did they find out. The down bad electric vehicle maker learned that trying to raise $1.67 billion in a secondary sale and private placements is certainly not the way to go, but nonetheless, that's what they're going to go ahead and do. Lucid is selling 262.5 million common shares in a secondary offering. They're also going to be selling an additional 374.7 million shares as a private placement to Saudi Arabia's public investment fund, aka PIF. In total, compared to their current fully diluted shares outstanding number, at least via my calculations, which could be probably off anywhere between plus or minus 5% or so, but it looks like that's going to be dilution of about 26%. So, if you're an arbitrager, there's reason for the shares to go even lower from what they did yesterday. So just have that one on your radar. Finally, we have Elevance Health down 10.59%. You guys, if you're lucky, you don't know this company. They are a health insurer. This is a managed care provider in the United States, which I don't care nearly enough about insurance to learn what that means. But they're a managed care provider, which means they do government health insurance on behalf of the government. What more that means, I honestly have absolutely no idea. But either way, here's my idea. So, Elevance, our health insurer, tough day for them. They reported shitty Q3 earnings, coming changes to Medicare. It was the same thing with the United Healthcare that we talked about the other day. This is going to be lower bonuses for fiscal year 2026, and that's hurting their earnings expectations for that year. So because earnings expectations 2 years down the line are getting lowered, the share price now is going to be, this is textbook financial markets. You're expecting the payout to be less. So, it's basic time value of money shit right there. But really, what I think Elevance should do is just expand its business into ensuring stock losses against its own share price. I mean, you kill 2 birds with 1 stone there, People will buy your shares because they know it's insured against going lower, and then you expand your business opportunities as well because now you're insuring portfolio losses. Killing 2 birds with 1 stone over here at the Daily Peel Global headquarters. Anybody at Harvard, by the way, feel free to just send my my honorary MBA as an NFT because I think that idea alone is more than deserving of probably a fucking doctorate at this point, but as long as it's an NFT, then I'll accept it. All right, moving on down into our Thought Banana final story of the day. I'm actually not even peeing my pants here today, so good bathroom, good pee management on my part here. So let's everybody celebrate that for a quick second. It's Friday. We can fuck around a little bit. Okay, for our Thought Banana, we are talking about the vibes are off. Speaking of fucking around, let's go ahead and just act like we're on fucking Call Her Daddy or something. The vibes are off. So, we talked a lot about consumer spending a couple of minutes ago. Now we're talking about consumer sentiment. Now, with consumer sentiment, it was arguably even more confusing and concerning than the consumer spending data, and I can't imagine why. So, we have a perfectly friendly, honorable, highly esteemed presidential election going on between what strikes me as two very close friends between Donald Trump and Kamala Harris. There's peace all around the world. I mean, nobody's, what is there, a war going on or something? Not that I heard of, at least. We have an extremely trustworthy media establishment to keep us all well informed about all of this. So I really don't understand what the problem could be among American consumers. But let's go ahead and talk about why they're confused. So in the last week or so, the New York branch of the Federal Reserve, as well as the University of Michigan, have published their latest findings from their respective sentiment surveys. None of them make any sense, not that we expect too much from these Nobel laureate bunch of fucking American consumers, but it's a little bit weird. So, according to the New York Fed's numbers, which they do ask very different questions, so it's kind of understandable how they could diverge as much as you're about to see, but it's the internal divergence that doesn't make any sense on either side. So, part of the New York branch of the Federal Reserve, part of their survey is asking about inflation expectations going forward. So Michigan will ask if you think it's going to be higher or lower. New York Fed is asking, what do you think the rate is going to be? So based on consumer responses, since July, expectations of the median rate of inflation in the next 3 and 5 years have climbed higher for the past 2 months. They've gone from 2.3% to 2.7% on the 3-year side and 2.8% to 2.9% on the 5-year side. That might not sound super weird. Yes, inflation has been stickier than many expected, so that could be the driving force there. But in the exact same survey, out of the other side of their mouth, consumers said that they also expected the hiring market to get weaker. They expect their earnings potential to be slightly weaker. Instead of 3.1% growth, it's 3% over the next year or so. Those are the inflationary forces that would be pushing inflation higher. I mean, unless consumers are calling for a higher than expected deficit or something, if they went home and ran the numbers on the fucking capital account versus the trade account or whatever it might be, I don't know if fucking Jim Bob from the goddamn auto repair shop is going home to do that. But still, there's no other reason for why you would expect inflation to be increasing while you're anticipating a weakening job market. I mean, that makes absolutely no sense, but nonetheless, that's exactly what consumers said in the New York Fed's sentiment survey. University of Michigan, rating national champions. I expected more from you guys, to be honest with you. But within the University of Michigan survey, it was only just as confusing. So consumers' inflation expectations did continue to decline. Now, UMich uses a 3-month rolling average when they report this, but it did continue to decline. It's currently sitting at right about 3%. But at the exact same time, the percent of consumers citing high prices as a concern for them just set a new record high. Make it make fucking sense to me. You're expecting, do you think you're literally saying, inflation's not as much of a problem now, but higher prices is my top concern? I don't understand how that could possibly make any sense. Maybe it's because consumers are saying, okay, inflation has racked up so much that these high prices that we're getting right now aren't going lower, but they damn sure aren't going higher either. It could be them saying that, but again, I don't want to give consumers too much credit there. I don't think that they're going to fucking even realize that. I mean, if you called me on the phone, I probably wouldn't realize that while I'm answering these questions. I don't mean to shit on, the fucking people who weren't nerdy enough to go and get an economics degree like I did. So, I mean, no disrespect or anything, but holy shit, make it make fucking sense. I don't understand what's going on. Again, this is symptomatic of the general economic opacity, and it's probably contributing to a lower propensity to spend when it comes to the consumer spending side. And all around, that's not looking good for the economy. Sentiment generally isn't a great kind of indicator, but as it relates to consumer spending, it certainly can be. And then the consumer spending is really the whole kit and caboodle. So that's the reason we're a little bit more fired up and concerned than usual here today. But as of right now, it seems like the Goldilocks period in the U.S. economy is still rolling on, but we just certainly hope the bears aren't on their way home just yet. Okay, so that about does it for us today. We'll leave you with a quote from one of my personal favorite economists who I've only recently discovered. I purchased his book on Amazon, but it hasn't arrived just yet. But I'm looking forward to reading it. Anybody heard of Mr. Thomas Sowell? He wrote the book that I bought is Basic Economics. I guess that's kind of like his magnum opus. But I'm more into the old economic stuff. If we look at Hayek stuff from the 30s and 40s, if we look at Friedman stuff from 60s, 70s, 80s, if we look at even I just bought my brother what's it called, Ayn Rand's book. Jesus Christ, I read this and I can't even remember the title of it. Atlas Shrugged. Just bought him that, so hopefully he'll enjoy that. But that's the kind of economic writing I'm into. But I'm excited to check out Thomas Sowell's stuff. But he's 90-something years old at this point, but it's still, I guess, is considered a little bit more new age than some of that older stuff. Either way, the quote of the day that I want to leave you with is, Actually, one of my favorite ones that we've done in quite a while. I know this is quite the build-up. It's nothing profound or anything. It's more so funny than anything. But he said, people who enjoy meetings should not be in charge of anything. And I could not agree with that more. There is nothing worse than when I see a meeting come across my calendar. But hey, we do what we got to do out here. If any of you guys would like to book a meeting with me, please do. Shoot me an email. Love to hop on, chat with you, talk with you. Nobody sent me anything today, which I'm a little bit disappointed about. But still, send me some cool shit, and maybe we'll yap about it on here. And let me know if I can shout out your name there too, and how much fun of you I'm allowed to make, because I would absolutely love to do that. Nonetheless, let me go ahead and stop yapping and let you guys get back to your days out there. What do I usually say at the end of this? Happy investing, happy trading, and bye now.